Hello, Capstone students. Chapter 8 is about where to get money if you want to start your own business. And what are the advantages of going with borrowing or, bringing partners and all of this. Now, let's start with this chapter has 11 outcomes. One of them is explain the advantages and disadvantages of bootstrapping. That is when you want to start a business with a minimum amount of money. Of course, when you start with a minimum amount of money, one of the best advantages, of course, you are not tying a lot of capital. And if the business goes bankrupt, you won't be as much sorry. And therefore, another thing is that sometimes to raise a lot of capital, it might require a significant amount of resources. It might postpone your projects, and therefore, and also when having too much money sometimes in your hand, you start spending them, and suddenly you end up, spending a significant amount of capital without, being able to establish the company. The expenses can go very high, and you might not be as careful as spending money. Therefore, bootstrapping has its own advantages and disadvantages. What is the disadvantage? Sometimes your business might grow slowly. Imagine that suppose you need to buy a truck for your company, but because you don't have as much money, you won't be able to buy the truck. Imagine you are involved in farming and you need a good truck, and if you don't have that truck, therefore, if you try to, go and rent a truck, or that will be a lot of headaches, and therefore sometimes having a lot of capital, having access to a lot of capital, of course, is very good. You can have a business that is moves fast, and you can establish it faster. However, sometimes, starting with a little money, suddenly you can quickly get it started, and, it has advantages and disadvantages. Now, let's say if you want to start a business, you have two options. One is that going to a rich doctor and tell the doctor, okay, doctor, I am going to start my own business, and then I want to make you a partner. That means in that case, you are using equity financing, means you are giving, let's say, half of your business. Imagine if it is a restaurant, you are giving half of the restaurant to the doctor, and half of it is yours. In that term, the doctor comes and gives you $100,000. He will be, the owner. Half of the restaurant is his or hers. But the problem with that is that if next year your profits are $200,000 a year, you would come and say, why did I bring the doctor in here? I wish, or you wish that you had not brought that rich person to own half of the business. Your wish is that you could own all of it. That way you could pocket all the $200,000 profit. In that term, in that case, your wish would have been that you could go to bank rather than borrowing it from the doctor to make him a partner. You would have gone to the bank and asked, could you give me $100,000? I have my $100,000, but I am $100,000 short. I want to start my own business. Then you could have the entire restaurant to yourself. And what you could do, if next year you had $200,000 of profit, you could, pocket all of it, all of the profits. Therefore, there are advantages. And also, one of the disadvantages of this debt is that suddenly, if you don't have, let's say, if you don't have any profits, let's say next year, if you don't have any profits, the doctor is not gonna, that doctor who gave you $100,000 is not gonna to ask you for any money. You go there and say, we didn't make any money. And he would say, she would say, okay, no problem, we didn't have any money. However, if you had borrowed money from the bank and you don't make any business, you don't sell any food for 1 year, you have very few customers, but that bank is not going to be lenient on you. They want, their mortgage, their money that they gave you, they want, the payments. Maybe it might be $1,000, $2,000 a month. If you don't have, they are going to force you into bankruptcy. Therefore, having, the equity financing means bringing more partners, have its own advantages and has its own disadvantages. And that sometimes have its own advantage. Sometimes you might have, a benefit of tax benefit when you have a debt, Therefore, there are a lot of issues when you start in business, whether you want to, borrow money or whether you want to give the ownership. When you give the ownership away also, sometimes you are not in charge of everything, Suddenly the doctor might put 110,000 and become, and becomes, the owner of 51% of the company. You become 49% of the owner of 49% of the company. In that term, then the doctor can fire you if he has or she has the majority shares of the company, of the restaurant. Then he can be the major decision maker, and you lose the your grip on the restaurant, and simply because you use equity to finance your company. If it was $102,000 of the bank couldn't be considered as the owner of the company. It was the creditor. Therefore, as there you have to, and big corporations are like this. Sometimes they are private, and that means they are not selling any stocks to the public. When they are not selling stocks to the public, they have less headaches, they have less paperwork, less dealing with IRS, less dealing with Securities and Exchange Commission. That's an organization that usually is in charge of seeing to make sure that the companies are not cheating the stockholders, because now the company is public. But when they become private, there will be less regulations, less investigation by the government, and those things. They all have advantages and disadvantages. Discuss commercial loans. Commercial loans, and therefore is when you go to the bank and say you want to open a restaurant, you need some money. Or social lending, you can go to some, go and go fund me. This is a funding websites, and then you go and ask for money, and raise the capital in different ways. You can raise it through the banks, loans, commercial, or through the doctor. Or you can go to the people that you don't know. You go to the internet and say, I have this particular business idea in mind. These are my credentials. I am a good person, and I am looking into raising this much money. If you give me this much money, I can, make you the owner. Even you can give them some shares, giving them some shares. Let's say if you register a corporation in the state of West Virginia and say you want to start your own, restaurant, maybe you want to open it as a C corporation, and when you open, or as C corporation means suddenly the state might tell you, okay, we let you open your own restaurant under C corporation rather than sole proprietorship. In that case, they would tell you, or under partnership, in that case, they say, do you want to have some shares that all of the shares are yours at the beginning? You say, yes, you want to have 2,000 shares. And of course, those shares, if you put $100,000, those shares, of course, would, value something. If you don't put any money or anything in the organization, those shares, you might have 100 shares, but those shares might not worth anything, $1 or $2, or some. Therefore, you can take that $1 or $2 a share and go to some people and say, you have 50 shares, you want to sell that to 50 individuals, each one can have one share, and you want $1,000 from each. If they feel you have the equity, you have some capital in the organization, they might come. 50 people, might see that it's an excellent restaurant, it has the potential. 50 people might give you, they look at that and they see you, or you put almost, $50,000 of your own. They come and put 50, each one of them $1,000, and that means you were able to raise the capital by being creative. Explain initial public offering as a source of capital. Imagine that your restaurant picked up and became a very famous restaurant, in Moorfield. Now you want to expand it into the cities, other towns, and many companies started like this. Suppose Starbucks started like this. Starbucks coffee fairs were about 3 small stores somewhere, and a very smart person whose name is, I think, Schultz, Howard Schultz, went to the owner of these small coffee shops and said, "Sir, I am a good manager. Would you allow me to run these coffee shops? He said, "Okay, you come and run these three coffee shops." He ran the three coffee shops, and he was a smart guy. He's a smart guy. And suddenly he went to the owner and said, "Okay, now let's expand." They expanded. They made the three shops. They made it 20, 30, and as soon as they got maybe 200 to 300, then they said, "Let's go public and offer initial public offering," which means in that case they went to the stock market. They went to an investment bank and said, "Okay, let's have 1 million, 2 million shares, and let's sell it to the public." And in that case, they could raise a lot of capital. Why did they want to raise a lot of capital? Because they had 100 stores and they wanted to have 10,000 stores. To have 10,000 stores, they didn't have the capital. They couldn't get the money from the bank. Therefore, they went to the stock market. They went to the investment bank, and that investment bank, sells the shares and raises the capital. Maybe gets $200 million for them. And by doing so, they went public. Rather than being private, they went public and they were able to raise capital. Describe special purpose acquisition companies, SPACs. These are the companies, sometimes they take over another company. In fact, Donald Trump, as you all know, has his own social media company, which he calls it Truth Social, Social Truth. That is, it's just like, Twitter, And then what he did, he used, a concept known as special purpose acquisition. While he had just the idea, he had not established it, he went to another company that was already established. He said, "I have this idea, please come and take over my idea, give me some money." Therefore, he used some kind of creativity to establish his through social company. Therefore, that is another way of raising capital when you don't have capital. Discuss private placement as an opportunity for equity capital. Private placement is when you are not going to public and raise public capital. In that case, you can go to individual. We already gave you an example of a doctor. It might not be a doctor. You might go to venture capitals. What is the venture capital between the venture capitalist and investment banks and another? We have three types of investors. I don't know whether it was this class or another class that I talked. Some investors are called angel investors. Angel investors are rich people, just like the doctors, lawyers, some people who have some millions, $10 million in the bank. They want to, see, or $1 million. They are looking for opportunities, and I said angel capital. Angel investors are the ones just like the doctors, and they come and have some money. But sometimes you might need more money than the doctor can afford. Imagine that, you have started your own business, and this business now from one restaurant, you want to go to 20 restaurants. When you go from one restaurant to 20, the doctor doesn't have enough money to give you, up to 100,000 he or she can give, but 1 million or 2 millions, if you don't have, you go to venture capitalists. Do we know some venture capitalists? Some of you might have seen the TV program Shark Tank, that they invest in, the people come. Venture capitalists are the ones who have a lot of money, and they much more than the doctor, and they have millions of dollars. And what they do, they look for opportunities. Particularly, they look for startups, because they know that startup businesses can move quickly and fast. Therefore, they take major risk, and they put their money. Maybe they invest $1 million in 10 different companies. And then guess what? If they invest 1 million in 10 different companies, that means they are investing 10 millions. And then out of 10 businesses, suddenly 9 of them might go bankrupt. But what happens is that one company that doesn't go bankrupt suddenly becomes $100 million company. And suddenly these venture capitalists who lost $9 million, then can go and take that company, that single company, they will take it public, and suddenly the venture capitalists will get $50 million back. Do you see? That's how they operate. The venture capitalists, take the risk and they look at the opportunities, they look at the business plan. If the ideas are good, they put their money and they know that they are taking risk, but they are hoping that one of the companies they are investing is going to be very successful, and hopefully they can take that company to public. And also when they put their money, they will have, a seat on the board of that company. That way they to make sure that the entrepreneur doesn't do crazy things. That way they can also guide them, just like Ashoka, that helps you. Ashoka is a non-profit, but these venture capitalists are after money. They want to make big money. That's why they are partnering with you. If you have a good idea, they like to hear from you. And they are very smart people, and therefore that is venture capitalists. However, venture capitalists might give you $1 million. Imagine that you need $30 million and you don't want to take it as an initial public offering. What would you do? You go to someone who has more money than venture capitalists. Who has more money than venture capitalists? Maybe investment banks. Investment banks will hear from you. You go and say, I have as many as 200 coffee shops. I want to make it 400. The venture capitalists, can give me 1 million, but my problem is that I need 30 million. Then maybe investment banks give you money, they put the investment, in it. And even if you need much more, then in that case, the investment bank says that let's take it to the public and sell their stocks and collect a lot of millions, tens of millions, hundreds of millions from the investors. And that's how they raise capital. Discuss private placement, which we did say the private placement is when you raise capital privately. You don't take it to the public, means not public offering. Therefore, you raise your money through the doctor, through venture capitalists, or through investment banks, and discuss as an opportunity for equity capital, which means you bring those owners, the doctor can become a partner of your business, your coffee shops, or the venture capitalists can become partner, or the investment bank. These are all private placement. They describe the rise of crowdfunding. Crowdfunding is, some people know what you might have heard of it. You go to the internet, or you go to some sources of internet sites that you go and describe your idea. You don't know who the other people are. You say that I have this idea and I will need money and I need $1 million. And the people look at it. If it is a great idea, maybe the people, that you don't know who they are, they contribute, and of course they become the owner. Of course, you need a lawyer, and they might have a lawyer. You say, therefore you sit down and you raise money, and therefore explain market for venture capital. That's when we discussed, what venture capital is. And usually venture capitals like to put their money, they usually put it in risky, businesses. Of course, they want to take as least risk as possible with their money, but sometimes they see the potential. If they see the potential, they say maybe it's worth the risk, and, they get involved. Describe venture capitalism, we already said, evaluation criteria for new ventures. And they have some formulas, They look at you and say, okay, this person has 40% chances of success, 60% chances of, failure. Don't think that because they think you have 60 chances of failure, they are going to tell you no. They might tell you yes. Why? Because you are not the only one they are investing. They are investing in 10 other businesses. Each one of them has 40% of success and 60% of failure. Therefore, out of 10, suddenly if one of them makes it, the venture capitalist has made a lot of money. Do you see that? Therefore, they have criteria. They look at to see who you are. Are you a trustworthy person? Are you smart? They look at your business idea. They do their own market research, and they are experts. They know what, when you talk to them, they go and they have some, great people who can analyze your ideas, and also they provide you with some guidance, which is great, and mentoring, and they become a board member of your company, and guide you through, and you become involved. That means you get a partner that is capable and has money, and they are after money just like you as as an entrepreneur. Explain the importance of evaluating venture capitalists for proper selections. These venture capitalists, there are some major ones are in, some of the major ones are in California, because many of them are in Silicon Valley, in San Francisco area. Many of them, because there are a lot of technology company startups, they are there and they have significant amount of money in their disposal, and they look the ideas every day. They might get 200 300 business plans from smart entrepreneurs who want to get their businesses started. They read it, they read them and they analyze them, and suddenly you see that maybe out of 200 business plans they get, maybe they select one or two of them, but they just reject as many as 198 of them. And as I said, they are into the business of making money, and there are some that are very famous, that they do the major investment. Many of these big companies, that Facebook and Google and these companies that they start, they go to these venture capitalists and get their money first from them, and those venture capitalists become the part owner of YouTube. Facebook. And then when this go public, then the venture capitalists make a fortune out of that. Therefore, that is another idea. Describe existing marketing in informal risk capital market. Therefore, as you know, many of startups, have problem and might have, a lot of issues. Therefore, as an investor, the investors are careful about where they are putting their money, and particularly new startup companies, have a lot of risk associated with them, but they have a lot of potentials as well. Therefore, this is a good chapter we want you to read. Some of you might decide to start your own business. Know about the different types of corporations. If you want to start, I know some of you are interested in having, starting a farm, cattle, and all those things. Where you want to get your money, it's a great idea. You already know how to use this ChatGPT, Grok, and all this. Go there and ask them question. I want to start my own business. I want to start my own farm. I don't have money. Tell me where I can raise money. I am a graduate. Business is a graduate. And what I have my own small truck, but I need this. Therefore, put and see what kind of information. I live in this rural area. These are the potentials. What can you tell me? How can I expand? You ask for all of these, and hopefully you will get an answer. If you have any questions, let me know.